Imagine having enough money in life that whenever you want to buy something, you don't have to overthink or calculate every expense. Imagine enjoying a peaceful retirement, free from financial stress, and being able to secure a brighter, more stable future for your loved ones. So what's the secret to reaching that level of financial freedom? The answer is simple. Start investing now. In this audiobook summary, we'll uncover powerful lessons from the book Just Keep Buying by Nick Maggiulli, lessons that will help you build wealth and grow your money wisely over time. You'll discover why investing is not just important, but essential. You'll learn where to invest, how to navigate the ups and downs of the stock market, and what to do during a market crash. And that's just the beginning. Our hope is that by the end of this summary, you'll feel inspired to take the first step, or the next step, toward becoming a confident investor. Because when done right, investing isn't just a strategy, it's a lifelong habit that can lead to extraordinary results. So, what does just keep buying really mean? It's a philosophy, a simple yet powerful idea of consistently investing in a diversified portfolio no matter what's happening in the market. Whether prices are high or low, whether it's a booming bull market or a crashing bear market, the key is to keep buying. Just like paying your rent or grocery bills, investing should become a regular part of your routine. This approach doesn't require perfect timing or insider knowledge. All it needs is discipline and commitment. And in today's world, it's easier than ever. Thanks to modern platforms, investors have access to free trading, low-cost index funds, and diversified opportunities. You can now own a piece of some of the world's top companies with just a few clicks. So don't let fear or confusion stop you. As you'll discover in this summary, the process of investing is much simpler than you think and far more rewarding than you can imagine. Let's begin this journey of financial growth and long-term wealth. The first chapter is, why should you invest? There are 3 powerful reasons why you should start investing: to save for your future, to protect your money from inflation, and to convert your human capital into financial capital. Let's begin with the first reason, saving for your future. There will come a day when you may no longer be able to work, or perhaps you simply won't want to. But if you start investing today, you'll create a reliable source of income for yourself, even in old age. That means financial independence long after your active working years are behind you. It might be hard to imagine yourself at 60, 70, or 80 years old. Right now you feel strong, capable, and full of energy. And it's natural to think that it will always be this way. But research shows something interesting. Visualizing your future self can be a powerful motivator for long-term financial planning. In one experiment, participants were shown digitally aged photos of themselves, an image of what they might look like decades later. Surprisingly, those who saw these future images ended up investing 2% more in their retirement accounts compared to those who didn't. Just seeing a realistic version of their older selves made them more serious about preparing for the future. Another study asked participants why they save money. The results revealed that people who mentioned retirement or emergencies as their reason were more likely to save regularly than those who were saving for short-term goals like buying a house or going on vacation. So, if you're saving or investing for your old age, that isn't selfish, it's smart. You're simply securing your future so you won't have to depend on anyone later. Now let's talk about the second reason. Inflation. Inflation is like an invisible tax that quietly eats away at your purchasing power year after year. Whether it's groceries, education, transportation, or property maintenance. Prices continue to rise over time, even if your salary stays the same. In the short term, inflation might not seem like a big deal, but over the years, its impact can be enormous. For example, if the annual inflation rate is 2%, your money will lose half its purchasing power in 35 years. If inflation is 5%, that same loss happens in just 14 years. The higher the inflation, the faster your money loses value. So how do you fight back? The answer lies in investing. By purchasing assets that grow in value over time, you can beat inflation and preserve your wealth. Let's consider an example. If you had invested just $1 in long-term U.S. Treasury bonds back in 1926, that money would have grown to $200 by the end of 2020. But if you had invested the same $1 in a diversified basket of U.S. stocks, it would have grown to over $10,000 during the same period. That's the power of long-term investing. Now imagine you're retired. You're no longer earning a paycheck, but the cost of basic necessities keeps rising. If you've been investing all along, you'll still have a stable, passive source of income to support your lifestyle. Finally, let's explore the third reason to invest, turning your human capital into financial capital. Human capital refers to the value of your time, knowledge, and skills. While you can improve your knowledge and develop your skills over time, there's one thing you can't increase: your time. As you age, your energy and capacity to work naturally decline. You won't be able to do everything you can do today. Let's say you earn $50,000 a year for the next 40 years, and you consistently save 15% of that income while earning an average return of 6% annually. Over time, not only will you accumulate enough money to meet your needs, but the magic of compound interest will allow your wealth to grow even faster. Even after you retire, your investments will continue to generate income for you. If you start investing today, you'll be able to enjoy a peaceful retirement tomorrow. You won't have to worry about paying medical bills, securing your children's future, or covering day-to-day expenses. Even as you relax and enjoy life with your loved ones, your money will still be working for you, growing in the background and giving you the freedom you deserve. What should you invest in? Now that we've covered why you should invest, the next big question is, where should you invest? You've probably come across countless investment gurus on YouTube or read books that claim to show you the one perfect path to wealth. But here's the truth. There is no single universal route to becoming rich. There are many different ways to build wealth. What works for someone else might not be the best fit for you. That's why it's important to study different approaches and understand what suits your personal situation. Ultimately, your goal should be to build a diversified portfolio of income-producing assets, and that's exactly what the title, Just Keep Buying, stands for. Keep investing consistently across a mix of assets over the long term. So, what types of investments should you consider? Let's explore some major asset classes that can help you build wealth. We'll look at the benefits and risks of each, along with how to invest in them. But before making any decision, be sure to understand each asset thoroughly. Let's begin with stocks, also known as equities. When you buy stocks, you're buying ownership in a company. Stocks are one of the most reliable long-term tools for building wealth. A group of researchers studied the stock market returns of 16 countries from 1900 to 2006. Despite major global events like 2 world wars and the Great Depression, every single one of these countries delivered positive long-term returns. For instance, Sweden averaged an 8% annual return. The U.S. came in at 6.8%. and even the lowest, Belgium, had a 2.7% return. Another advantage of stocks is that they require no maintenance. Once you buy them, you don't have to manage them yourself, yet they can continue generating returns for you. However, stocks do come with a downside: volatility. Historically, stock prices have dropped by 50% roughly twice every 100 years, by 30% every 4 years, and by 10% almost every other year. These fluctuations can be emotionally challenging, especially for new investors. But the key is to focus on the long term. History shows that over time, stock prices recover and grow, even after major crises. Time, in this case, is your best friend. So how can you buy stocks? You can check with your bank or open an account with a reputable online stockbroker. You can purchase individual stocks, or you can invest through exchange-traded funds, ETFs, or index funds. The author, Nick Maggiulli, recommends index funds because they allow you to invest in a broad range of companies easily and affordably. For example, investing in an S&P 500 index fund gives you exposure to the top 500 companies in the United States. A total world index fund, on the other hand, lets you explore high-performing stocks from around the globe. As a shareholder, you can earn dividends, your share of a company's profits, alongside capital gains. Next, let's talk about bonds. Buying a bond essentially means you're lending money to a government or corporation for a fixed period. In return, they pay you interest, known as a coupon, until the maturity date when your principal is returned. The yield from a bond is calculated by dividing the annual coupon payment by the bond's purchase price. For example, if you buy a bond for $1,000 and receive $100 annually, the yield is 10%. When most books talk about bonds, they usually refer to U.S. Treasury bonds, but there are many other types: municipal bonds, loans to local governments, corporate bonds, loans to companies, and foreign government bonds. Non-U.S. bonds often offer higher interest rates, but they're also riskier. Why? Because, unlike the U.S. government, which can print money to pay its debts, other governments or corporations can default on payments during tough times. Since bond returns are usually lower than stock returns, they serve as a diversifying asset. They help balance risk. While they may offer modest returns, bonds are relatively safe and aren't as affected by market swings as stocks. Another reason to include bonds in your portfolio is their consistency. Even when riskier assets are down, bonds tend to provide stable returns. You can also use them as a source of liquidity. For instance, if the stock market crashes and you lose your job, having bonds allows you to sell them for cash without a major loss. But if all your money is in risky assets, you could face serious trouble. We saw this during the COVID-19 pandemic. Imagine 3 different portfolios: one with only S&P 500 stocks, another with 80% stocks and 20% bonds, and a third with 60% stocks and 40% bonds. When markets hit rock bottom in March 2020, the all-stock portfolio suffered the most. The 60-40 mix, however, held up better due to its bond allocation. In short, even with their lower returns, bonds can act as a safety net during crises. You can buy individual bonds directly, but the author suggests investing in bond ETFs or index funds for ease and diversification. You can explore these options through your bank or a trusted online brokerage. Now, let's move on to real estate. Investing in property can be a powerful wealth-building move. You can rent it out, allowing tenants to help pay off the mortgage, while you benefit from long-term property appreciation. If you take a loan to buy property, that's called leverage. For example, with $100,000. You can buy a $500,000 property by borrowing the remaining $400,000. If the property's value rises to $600,000, you can sell it, repay your loan, and still walk away with a $200,000 profit, doubling your original investment. But leverage can work both ways. If the property value drops to $400,000 and you sell it, you lose your initial $100,000 investment. Fortunately, such large crashes are rare, and over time, real estate generally appreciates. That's why many investors use leverage to their advantage. Now let's talk about the downsides. As a landlord, you'll need to manage tenants, maintain the property, and possibly list it on platforms like Airbnb. While real estate can deliver higher returns than stocks or bonds, it also demands more effort. It's not a diversified asset. You're taking on concentrated risk. If your property faces issues or a crisis like the COVID-19 pandemic hits, you could suffer significant losses. Still, if you're looking for more control and tangible ownership, real estate might be the right path for you. Just make sure to research thoroughly, consult experts, and prepare for the technical and legal complexities involved. Lastly, let's explore REITs, Real Estate Investment Trusts. REITs allow you to invest in real estate without managing properties yourself. These are companies that own and operate income-generating real estate. As an investor, you earn dividends from their profits. By law, REITs are required to pay out 90% of their income as dividends. There are different types of REITs. Residential REITs own apartments, single-family homes, student housing, and more. Commercial REITs focus on office buildings, retail spaces, and warehouses. REITs can be publicly traded, private, or non-traded public. Private REITs are offered only to accredited investors, those with a net worth of over $1 million. Public, non-traded REITs are not listed on stock exchanges, but may be available through crowdfunding platforms. Publicly traded REITs are available to everyone and can be bought like stocks. Instead of buying individual REITs, the author recommends investing in REIT index funds, which offer broader diversification. REITs often perform well in good times and can even outperform stocks. However, during market crashes, they can fall just as hard. That's why they're considered more of a risky asset than a true diversification tool. Let's now compare these income-producing assets. Stocks offer 8% to 10% average annual compounded returns. Bonds typically offer 2% to 4%. Real estate can return 12% to 15%. REITs generally return 10% to 12%. Other investment opportunities include small businesses, franchises, or angel investing, which can provide 20% to 25% annual returns along with high growth potential. Farmland offers 7% to 9% and works well as a hedge against inflation. Royalties offer relatively steady returns between 5% to 20%. However, cryptocurrencies, gold, and artwork don't provide reliable income and are highly speculative. They may or may not be suitable depending on your risk tolerance. Why you shouldn't buy individual stocks. There are two strong reasons why you should avoid investing in individual stocks. One is financial, and the other is existential. Let's start with the financial argument. Even the world's best professional investors, with full-time analysts and advanced research tools, consistently struggle to outperform index funds like the S&P 500. So, if they can't beat the market, what are the chances that you, an individual investor, will? Research shows that nearly 75% of actively managed funds fail to outperform their benchmark over a 5-year period. These funds are backed by highly trained teams, yet they still underperform. If the professionals can't consistently pick winning stocks, it's unlikely that casual investors can do better. Further studies reveal that only a tiny percentage of individual stocks perform well in the long run. One research paper titled "Do Stocks Outperform Treasury Bills?" found that between 1926 and 2016, just the top 4% of U.S. stocks were responsible for all the market's outperformance compared to Treasury bills. That means 96% of stocks either underperformed or failed to deliver any meaningful return. So, ask yourself this: what are the odds that you'll pick a stock from the winning 4% rather than the underperforming 96%? To make matters more sobering, consider this. If you look at the Dow Jones Industrial Average from March 1920, none of the 20 companies that made up the index back then are part of it today. Even the biggest, most successful companies don't stay on top forever. Picking the right stock is far more difficult than it seems. Beating the market is a rare achievement, even for the most skilled investors. The odds are stacked against you, and the risks of losing money are high. This is why owning a low-cost index fund or ETF is generally a smarter choice. Not only does it reduce your stress, but it also lowers the chances of significant financial loss. Index funds spread your risk across hundreds of companies, offering more stability and consistent returns over time. Now let's move on to the existential argument. This point questions your confidence and skill as an investor. How do you really know whether you're good at picking individual stocks? Will one good trade over a day, a week, or a year prove that you're a skilled investor? Probably not. In fact, it could take years to know whether your decision was based on skill or just pure luck. And even then, you'll have to wait and compare your results with an index like the S&P 500 to see if you truly did better. And here's another challenge. What if your outperformance isn't due to your analysis at all, but rather due to factors beyond your control? Suppose a stock you picked rises dramatically, not because you saw something others didn't, but simply because it got popular on social media. Would that still be considered skill? Let's assume you're a professional investor managing a mutual fund. According to studies, even professionals tend to underperform their benchmark over a 3-year period. And when that happens, they're left wondering, was it just a rough patch, or have they lost their edge for good? That's the existential dilemma. It's mentally exhausting and emotionally draining. Analyzing individual stocks, monitoring the market, and constantly evaluating your returns can quickly become a stressful, full-time job. Worse, a single drop in a stock's price can wipe out a large portion of your investment in just hours. Now, of course, we need stock pickers. Analysts and active investors do provide value. They help set prices and keep markets efficient. But for most everyday investors, there's a better way. By investing in index funds and ETFs, you can avoid unnecessary stress and reduce the risk of losing your hard-earned money. You don't have to guess which stock will win. You simply keep buying a piece of the entire market. It's not just a safer strategy. It's a smarter one. How soon should you invest? Let's brighten the mood a bit with some good news. Did you know that the stock market rises more often than it falls? In fact, throughout the 20th century, the Dow Jones Industrial Average grew from just 66 points to over 11,497. And this growth didn't happen in peaceful times. It happened while the world went through 2 major wars: the Great Depression, more than a dozen recessions, oil crises, a flu epidemic, and even the resignation of a sitting U.S. president. And this pattern isn't limited to the U.S. market alone. As we saw earlier, global equity markets have also shown long-term positive trends over the decades, despite facing numerous challenges. So, if the odds are in your favor, why wait? Every day you delay investing is a missed opportunity for your money to grow. The sooner you begin, the more time you give your investments to compound and multiply. So don't wait for the perfect moment. Just get started. Now, imagine you suddenly come into possession of $1 million, and your goal is to grow it steadily over the next 100 years. You have two options. You can either invest the entire $1 million today, or invest just 1% of it, that's $10,000, each year for the next 100 years. Which strategy sounds better? From a long-term growth perspective, the better choice would be to invest the entire $1 million up front. Why? Because the earlier you invest, the more time your money has to grow. If you spread it out over a century, yes, stock prices may rise, but the remaining cash sitting idle will slowly lose value due to inflation. Of course, putting all your money into the stock market at once may sound risky, but you can reduce that risk by building a diversified portfolio, perhaps 60% in stocks and 40% in bonds. This way, you still give your money the power to grow while protecting yourself from major losses. In fact, a 60-40 portfolio can outperform a strategy where you invest $10,000 in stocks every year, even though that approach is 100% invested in equities. That's the power of time and smart asset allocation. Now, maybe you don't have $1 million lying around, and that's okay. What matters is this: the stock market generally goes up over time. So the best time to invest isn't someday, it's now. By investing early, you not only give your money more time to grow, you also shield it from the slow poison of inflation. And most importantly, you take meaningful steps toward building a secure and comfortable retirement. So don't wait for the stars to align. Just keep buying. Start today. Why you shouldn't fear volatility. Here's another piece of investing advice that may surprise you. The biggest risk is not taking any risk at all. If you're afraid of stock prices falling and avoid investing because of that fear, you'll miss out on one of the greatest opportunities to grow your money. To succeed as a long-term investor, you must learn to accept volatility, market unpredictability, and the inevitable dips along the way. Let's consider a thought experiment. Imagine there's a magical genie who appears at the end of each year and tells you how much the U.S. stock market might drop at its worst point during the next year. Now, this genie can't tell you which individual stocks to pick or how the market will perform overall, but it can tell you the maximum intra-year drawdown, meaning the largest drop from the market's high to its low in a given year. Here's the question. At what point would you decide to exit stocks and move into bonds? What if the genie tells you the market could drop 40% next year? Would you still invest? What about a 20% drop? What's your personal limit? Before you answer, here's some context that might help. From 1950 to 2020, the average maximum intra-year drawdown for the S&P 500 was around 13.7%. The worst single-year drop happened in November 2008, when the index fell by nearly 48%. Now let's explore a few possible scenarios. Scenario 1. Suppose you're a very conservative investor. You tell the genie you won't invest in stocks during any year when the market is expected to drop by 5% or more. This strategy is known as Avoid the drawdown. In this case, you'd move your money entirely into bonds during those volatile years. But if you had followed this strategy from 1950 to 2020, you'd have ended up with 90% less wealth compared to someone who simply followed a buy and hold approach, staying invested in stocks throughout, regardless of market swings. Why? Because markets experience 5% drops almost every year. In fact, there were only 7 years in that entire 70-year span when the drawdown was less than 5%. So, by avoiding risk, you would have also avoided most of the stock market's growth. Scenario 2. Now, let's say you only skip years when the market is expected to drop by more than 40%. In this case, you would have only exited the market in 2008. And yes, this strategy might slightly outperform buy and hold, but the difference would be minimal. So we see two extremes. Avoiding all volatility results in massive underperformance, while trying to dodge only extreme crashes barely offers an edge. This leads to a more balanced strategy. Avoid investing in stocks only in years when the expected drawdown is greater than 15%. In this scenario, you'd shift to bonds during highly volatile years and invest in stocks during the rest. This method offers a good balance between minimizing risk and maximizing long-term wealth. Under this strategy, you'd be out of the stock market about 1/3 of the time, only during years with high volatility. But if you tighten your tolerance to 20% or 30% drawdowns, you'll end up staying in the market during its worst periods and lose money instead of gaining. Now here's the catch. There is no genie. There's no way to predict future drawdowns with certainty. You can't know in advance whether the market will drop 5%, 15%, or 40%. And because predicting future volatility is impossible, there's only one solution: diversify your portfolio. By investing across a variety of asset classes, stocks, bonds, real estate, and more, you reduce your exposure to the unpredictable nature of the market. Diversification won't eliminate volatility, but it can help you manage it and stay invested with confidence. And most importantly, accept that volatility is part of the game. If you can't stay calm when the market drops by 50%, which, historically, happens about once every century, then perhaps investing isn't for you. But if you can stay the course, that's how you win the long game. Because in the world of investing, fear is expensive, and patience is powerful. How to buy during a crisis. The COVID-19 pandemic shook the entire world, and the financial markets were no exception. On March the 23rd, 2020, the S&P 500 index had fallen by 33% from its recent high. If you were an investor during that time, what would you have done? Would you have panicked and sold your stocks? Or would you have held your ground, staying calm in the face of lockdowns, business closures, and overwhelming uncertainty? A famous quote from Baron Rothschild, an 18th century banker, gives us something to think about. He once said, "The best time to invest is when there's blood in the streets." Rothschild grew his wealth during the chaos of the Battle of Waterloo, when most investors were fleeing. His philosophy still holds true today. When prices are low and fear is high, that's when opportunity is greatest. If you buy when the market crashes, your investments can grow dramatically as the market recovers. Let's take a historical example. Suppose you had invested $100 every month in the U.S. stock market from September 1929 to November 1936, a period that covers the infamous 1929 crash and the subsequent recovery. Data shows that each $100 you invested would have grown by November 1936. But the most powerful gains would have come from the money invested during the lowest point of the crash, in the summer of 1932. Those $100 investments alone would have grown to $440 by late 1936. That's more than 4 times the original value, and this kind of explosive growth during a recovery isn't unusual. In fact, most market crashes can lead to 50% to 100% gains in the recovery that follows. Why does this happen? It's a simple but powerful mathematical truth. Recovering a loss requires a much bigger percentage gain. For example, to recover from a 10% loss, you need an 11.1% gain. A 20% loss requires a 25% gain. A 50% loss, you need a 100% gain to break even. If you were to plot this relationship on a graph, it would show an exponential curve, illustrating how deep losses require even steeper gains to recover. Take March 23, 2020, again, the S&P 500 was down 33%. According to the math, it needed a 50% gain to return to its previous high. And it did exactly that. In just 6 months, investors who had the courage to buy during that crash saw their money grow by 50% in half a year. Still need more proof? Let's look at data from every time the market dropped by 30% or more between 1920 and 2020. If you had invested during those drawdown months, your chances of earning less than 5% annually were under 10%. More than half the time, you would have earned over 10% annualized returns. Now here's the kicker. If the market had dropped by 50% and you invested at that point, your odds of earning over 25% annualized returns were greater than 50%. In other words, there's no need to fear market crashes. They often offer the best opportunities to invest and grow your wealth. Historically, markets tend to recover completely within a few years, or at most, a decade. Still skeptical? A study of 39 countries from 1814 to 2019 found that the probability of inflation overpowering long-term stock market returns was just 12%. That means there's only 1 in 8 chance that inflation would beat your investment returns over 30 years. Now, here's one last perspective. You might think, what if I invest at the absolute worst time? Take the Japanese stock market, for example. If you had invested a lump sum at its peak in December 1989, you might still be underwater decades later. But what if instead you had invested just $1 a day from 1980 to 2020? Even with the crashes and lost decades, you would have earned a small positive return. This is the power of consistency. This is the power of just keep buying. So ask yourself, will you sit on the sidelines, paralyzed by fear every time there's a crash? Or will you take action, investing while others hesitate, and position yourself for massive gains? Because the truth is, those who invest during a crisis don't just survive. They build real wealth. Eventually, stock prices will climb 25%, 50%, maybe even 100%. The only question is, will you still be waiting, or will you already be on your way to becoming rich? When should you sell? This book encourages you to just keep buying, to invest regularly and consistently. But eventually, there will come a time when you'll need to sell. And that's one of the hardest decisions in investing. Why? Because your emotions will try to convince you to hold on a little longer, hoping for even more returns. Or they'll urge you to sell immediately to avoid potential losses. To avoid falling into that emotional trap, you need to be clear about one thing. Never sell impulsively. Instead, Sell for specific reasons, either to rebalance your portfolio, exit a concentrated position, or fulfill a financial need. Outside of these three reasons, avoid selling just to dodge taxes or chase market timing. Before we break down these situations, let's remember this. Sell at the right time, not in haste. As we've discussed earlier, the market tends to rise more often than it falls. Even if you decide to sell years from now, chances are that your investments will have grown, but if you sell too early, you might miss out on the next big uptrend. That's why the smart move is to buy now and sell gradually in a way that maximizes your long-term wealth. Let's start with the first scenario, selling to rebalance your portfolio. When you start investing, you usually set a target allocation. For example, 60% in U.S. stocks and 40% in U.S. bonds. If you have $1,000, that means $600 in stocks and $400 in bonds. But over time, your higher return assets, like stocks, will begin to dominate your portfolio. If you never rebalance, your asset mix can drift far from your original plan. For instance, if you had invested $1,000 in 1930 and didn't touch it for 30 years, by 1960, your portfolio would have shifted from 60-40 to somewhere between 75% and 95% stocks. On the other hand, if you had rebalanced annually, your allocation would still remain close to 60% stocks and 40% bonds. That's because stocks outperform bonds over time, and rebalancing allows you to gradually lock in those gains by shifting some profits into safer assets. Yes, the never rebalance strategy may outperform slightly due to higher stock exposure, but smart investors rebalance to control risk. The goal of rebalancing isn't to maximize returns, it's to protect against unwanted volatility. Without it, your portfolio could morph into something far riskier than you originally planned. Annual rebalancing is often the most practical approach. You only have to do it once a year, which means less monitoring and more peace of mind. Trying to rebalance every time your stock allocation hits 70% or drops to 50% can be stressful and inefficient. You can also rebalance during tax season, selling off gains and managing capital gains taxes all at once. This approach saves time and effort. But frequent rebalancing can lead to higher taxes and may actually reduce your wealth over time. There's another way to rebalance without selling. The author recommends this approach. Instead of selling your winners, simply buy more of the lagging asset. For example, if your portfolio drifts to 70% stocks and 30% bonds, you can fix the imbalance not by selling stocks, but by buying more bonds until your allocation returns to 60-40. This way, you avoid capital gains taxes and continue investing regularly, especially useful during market downturns when buying more can yield better results. However, this strategy works best for investors still in the accumulation phase. If your portfolio has already grown significantly, continuing to buy more might not be feasible. In such cases, selling to rebalance may be necessary, but try to minimize how often you sell to avoid unnecessary tax costs. Let's move on to the second reason to sell: exiting a concentrated position. This means having a large portion of your wealth tied up in a single asset or stock. For example, if you work at a company that offers equity compensation, over time, you might find that a significant part of your net worth is linked to that one stock. That's not necessarily a bad thing, until it is. As your position grows, it's wise to start selling small portions to reduce your risk. How much you sell depends on your goals. Let's say you have a mortgage and the majority of your wealth is in company stock. You could sell a portion to pay off the mortgage. Yes, that stock might grow faster than your home's value, but that growth is just a possibility. Your mortgage, however, is a guaranteed obligation. You could sell 10% each month or offload 50% at once and hold the rest. That's up to you. But one rule stands. Don't sell it all at once. Large sales can lead to hefty tax consequences, and you might regret it if the stock price rises later. That said, remember this. Individual stocks often underperform indexes like the S&P 500 over time. So ask yourself, what level of risk are you comfortable with? And based on that, plan your selling strategy. Finally, let's discuss the third reason to sell: to enjoy your life. Whether it's funding a comfortable retirement or taking a summer vacation, paying for your children's education, or covering your family's health care, using your money is not a bad thing. The author highlights a concept called diminishing marginal utility. This means that the more you have of something, the less valuable each additional unit becomes. For example, increasing your wealth from $0 to $1 million brings much more happiness than increasing it from $1 million to $2 million. Once your family's needs are taken care of, additional luxury doesn't add much joy. But giving your loved ones meaningful experiences, that's priceless. So yes, selling isn't a failure. It's a part of the game. The real purpose of investing isn't just to grow your net worth. It's to create the life you've always dreamed of living. Conclusion. Let's quickly revisit what we've learned from this powerful journey through Just Keep Buying. First, you understood why investing is so important. To save for retirement, to protect your money from inflation, and to convert your human capital, your time, skills, and effort, into financial capital that works for you even when you no longer can. Second, you explored different types of assets: stocks, bonds, real estate, and REITs. Each asset class comes with its own benefits and risks. That's why it's essential to build a diversified portfolio, one that not only grows your wealth, but also helps you manage risk effectively. Third, you discovered why you shouldn't buy individual stocks. Picking winners is incredibly difficult, even for professional investors. Instead of chasing performance, invest in low-cost index funds or ETFs and let the market work in your favor. Fourth, you learned the importance of starting as early as possible. Every day you delay is a missed opportunity for your money to grow. So if you want to beat inflation and build wealth, the best time to invest is now. Fifth, you realized there's no need to fear market volatility. Trying to time the market or avoiding it during downturns only causes you to miss out on valuable opportunities. Instead, focus on building a diversified portfolio and stay invested for the long term. Sixth, you learned how powerful it is to keep buying even during a crisis. Yes, downturns can be scary, but most stock markets recover within a few years, sometimes even faster. And because every percentage of loss requires an even larger percentage of gain to recover, buying during crashes often leads to the highest rewards. In other words, crisis creates opportunity. Finally, you discovered when it makes sense to sell. Don't let emotions guide your decisions. Instead, sell only to rebalance your portfolio, to exit a concentrated position, or to fulfill important financial needs. Selling at the right time and for the right reasons helps you stay on track while minimizing unnecessary stress and taxes. Every day, we're faced with financial decisions, all while being uncertain about the future. We don't have a magic lamp. We don't have a time machine. But what we do have are timeless principles. Principles that you've now heard in this summary. If you follow these simple guidelines, you'll be well on your way to long-term financial success. Yes, you can become wealthy. But it all starts with one decision. Start investing as soon as possible. So no matter where you're starting from, no matter what's happening in the world, just keep buying.